Good afternoon. Welcome. Glad to have you here. Glad to have you here filling up this room. We understand there's also an overflow room where some people are watching and listening in. Glad to have you here with us as well. My name is Wayne Abernathy. I'm Executive Vice President for Financial Institutions Policy at the older ABA, that's the American Bankers Association, and I'm also Chairman of the Executive Committee of the Financial Services Practice Group of the Federalist Society. And we're the ones that our practice group is sponsoring today's presentation, discussion. Credit to Cronies, government's heavy, if hidden, maybe we ought to say not so hidden, hand. Before I introduce our distinguished moderator, who in turn will introduce our panel, I have 2 points I need to make. First is, if financial services stuff, policy and so forth interests you, and you'd like to be more involved in what the Federalist Society does on those particular issues, please have a chat with me, and we're happy to get you as involved as you'd like to be. We always want more and more people involved in what we do. We like to have as many ideas and, of course, as many hands helping to do the work. And I think you'll find there's plenty of work to be done in this area. The second is that, unfortunately, we suffered a late attrition to our panel. We lost a member who had originally been able to attend. So to ensure that a proper and wide range of relevant issues are set before our panel here today, our moderator today will, amongst his duties of moderating, will also be placing on the table various kinds of issues and questions that are the kinds of things we think that our panelists who couldn't be here with us would want to have before us in the discussion today. So hopefully we'll therefore be able to be looking at the issues from a variety of perspectives, which is, again, what we like to do here at the Federalist Society and at this session. Our distinguished moderator is Paul Atkins. He's well known to financial services practitioners and policymakers, having been involved in both aspects of that. He's the founding member and CEO of Patomak Global Partners. Paul also served across 6 years as a commissioner on the SEC, and when I say SEC, I mean the Securities and Exchange Commission, not the Southeastern Conference, although I expect the relatives in South Carolina, I'm not sure which they would consider to be a higher credential, so we'll leave that at SEC as it is. Paul's scholarship and seasoned perspective have also brought him the role as being a visiting scholar at the American Enterprise Institute. We're proud and happy to have Paul Atkins moderate our panel today, and please join me in welcoming him this afternoon. Thank you, Paul.
Well, thank you very much, and welcome to the folks in the ether up there in the overflow room. So I'm glad you all could come and participate with us here in this panel. And I chose to stand up here because I couldn't really see anybody beyond this podium over there. So, but anyway, so hope we'll have a good, lively discussion. Like Wayne said, we had last-minute attrition, so I used to be for a period of time on the Congressional Oversight Panel for TARP, where I served with Elizabeth Warren, who was our chairman. So I'm going to try to channel Elizabeth today as we try to discuss some of these issues. But anyway, so what our whole topic is today is credit and crony capitalism in the credit markets and the government's heavy if hidden hand. And that's we see that overall as things led up to the financial crisis in 2008. We know that Fannie Mae and Freddie Mac were one of the real crucial aspects that led to that market problem that we had, and it's still, of course, not solved. And now that we have a new Congress coming in, that's maybe one of the things that we'll talk about today is what are the prospects for change in that realm. But as with anything else, when government gets involved in the marketplace, and there are always distortions as it crowds out private enterprise and other market signals. And we know from Milton Friedman and other economists just how important those market signals are and how it fails repeatedly in centrally planned economies, whether it be the Soviet Union, today's China, or also, of course, in the United States, as we've seen. And unfortunately, of course, coming out of the financial crisis, Congress did not learned the lesson, and we saw with the passage in 2010 of the Dodd-Frank Wall Street Reform and Consumer Protection Act, a lot of heavy-handedness of the government in the markets. And so I like to say, whenever you hear in the same line in Washington, reform and consumer protection, you really better watch your wallet, because it will be picked. But coming out of Dodd-Frank, really, Title I of Dodd-Frank is called financial stability, and that really is the leitmotif of Dodd-Frank. So you could really term it, I like to say, stability über alles is what is the whole goal of Dodd-Frank. And so we see that in the empowerment of the Financial Stability Oversight Council, that key word again, where they are looking at banks and how to try to direct banks into various things. And they are now expanding their view of the marketplace from just banks, which is what the Fed and the Treasury and others are used to regulating, to other things, of course, with insurance, and we've seen with Prudential and MetLife how they are now supposedly designated as systemically important financial institutions, SIFI for short, but some people call it SIFI. I refuse to say that. Just like with hi-fi, Wi-Fi, this is sci-fi in all sorts of meanings of that phrase, but the fact that the government arrogates upon itself the ability to go in and try to direct private enterprise to various aspects of the financial market, I think is a fool's errand. And their latest thing that they are talking about doing, I think, is something that all of us ought to be very concerned about, is focusing on asset management and talking about designating asset management as a systemically important activity, which would then give the Fed the ability to tell asset managers under their prudential authority whether to forbear, and, for example, in selling a particular security if they think that they need to do it on behalf of their fund or their customers. So that would be an unprecedented abrogation of fiduciary duties. So that's beyond the remit of this panel, but it's just an illustration of what the government is getting into in the wake of Dodd-Frank. And so some of those things I think we're going to be focusing on, including, as we've seen here recently, with the various federal financial agencies approving what's called a qualified residential mortgage, which started out when one of our panelists was actually in the government, started out with sort of a high-minded goal coming out of the directives of Dodd-Frank. But what we've seen lately is how the politicized nature of things have really undermined that whole thing. And so we are now facing the possibility of financial institutions giving credit for zero down payments, no mandatory down payments coming out of these, and they would still be recognized as qualified under the law. So with that little bit of teasing, let's get down to the to brass tacks here, and let me introduce our panelists so that we can hear their presentations and then get into our discussion. First, all the way to my far right is Bert Ely, who's the principal of Ely & Company. And he's an expert in monetary policy and the regulation of banking and financial services. He's specialized in deposit insurance and banking structure issues since 1981. And before that, he was at Touche Ross, and he was an auditor with Ernst & Ernst. But he has been monitoring conditions in banking and thrift industries, and including the growing politicization of credit allocation. And he consults on current legislative and regulatory trends in Washington. He's an expert witness and does expert testimony in all sorts of litigation. So happy to have Bert here with us. Next to Bert is Ed DeMarco, and we're happy to greet him here. He's a senior fellow in residence at the Milken Institute Center for Financial Markets, and he's a visiting professor at my alma mater, Vanderbilt, at the Owen School of Management in Nashville. So from September 2009 to January 2014, he served as acting director of the Federal Housing Finance Agency, which is the overseer and now conservator for Fannie Mae and Freddie Mac. and the regulator of those companies and of the federal home loan banks. And prior to being acting director, Ed was the COO and senior deputy director of FHFA and its predecessor agency from 06 to 09. From 03 to 06, he was an executive at the Social Security Administration, where also Milton Friedman was, maybe way to its predecessor many years ago. And he was assistant deputy commissioner for policy. So we welcome Ed here, and I have to say, just personally, you know, he's been a hero of mine, although I just first met him today, but he basically stood up to all sorts of political pressures during his acting directorship there. And so I think it's really a testament to the rule of law, people standing up for the rule of law as a civil servant, so happy to have him here. And then Paul Kupiec, to my left, is a resident scholar at the American Enterprise Institute here in Washington, and he studies systemic risk and the management of regulations of banks and financial markets. Paul has a long history of work in financial services in the government side. He was at the FDIC, where he oversaw research on bank risk measurement and the development of regulatory policies such as Basel III. He was also director for the Center for Financial Research of the FDIC and chairman of the research task force of the Basel Committee of Banking Supervision, which is a group of central bankers based in Basel. So we welcome Paul as well. So first, what we want to do, and Bert, I don't know if you want to stay seated or come up here, but why don't you give us an overview of the situation as you see it?
Okay, can everybody hear me all right? Could we have the mic on? I'll just stay here at my seat. Our title of this program is Credit to Cronies, Government's Heavy Hidden Hand. So the upfront question is, what do we mean by credit to cronies? Quite simply, government influence in any form that directly or indirectly tilts the flow of credit towards political cronies, that is, those with political clout, and whether this tilt is intentional or not, away from those who are not cronies. The flow of credit towards cronies and away from those who are not is influenced by both the actual provision of credit through government credit programs as well as by government-inspired distortions in the price of credit. Now, what are the mechanisms by which government distorts the flow of credit within the U.S. economy as well as the total amount of credit? The answer, quite simply, is any government law or agency, federal, state, or local, which impacts the amount or flow and or the price of credit. The list of such agencies is nearly endless, so I will merely summarize them, but keep in mind that the multitude of payoffs to political cronies often work at cross purposes and even to the detriment of the cronies being helped. And I think the recent housing crisis is a good example of that. Now, what are some examples of explicit, obvious credit allocation distortions? Well, first of all, we have a number of government credit granting agencies, starting with the government-sponsored enterprises that Ed used to oversee, such as Fannie Mae and Freddie Mac, Federal Home Loan Banks, one of my favorites, the Farm Credit System, but also Federal Housing Administration, Export-Import Bank, and the list can go on and on. And then we also have a variety of government credit programs that are administered by various federal agencies. Rural Electrification Administration, a variety of U.S. Department of Agriculture programs. HUD, of course, has a number, as does the Department of Energy. But it goes beyond that to various policies, such as, again, in the housing finance area, one that is rearing its head is disparate impact, or, if you will, an implication that credit should be supplied to all on the same basis regardless of their riskiness. And we also see that in a variety of other forms of consumer lending, where regulation distorts the credit allocation process. And again, there are many, many examples of this throughout the government. We also have seen in recent years, since 2008, one-off crisis-driven credit support programs. The TARP program is one, and then the bailouts for AIG, GM, and Chrysler, and other such bailouts driven by a too big to fail doctrine. One of the implications of those bailouts is that there is an impact on how credit is allocated within the economy. Now, there are some less obvious distortions of the flow of credit in the economy, which nonetheless are quite significant. In the banking area, we have something called the Community Reinvestment Act, or CRA. Dodd-Frank created the Consumer Financial Protection Bureau, which is, we've heard reference to the qualified residential mortgage, but there are a number of other areas where they are starting to put in regulations that are going to have distorting effects. In such areas as prepaid debit cards and auto lending are two more recently. The tax laws are play an enormous role in that regard. And just to cite some examples, first of all, is the tax deductibility of interest by both businesses and individuals. That effectively favors debt financing over equity financing, and that in turn tilts the flow of credit towards those entities and activities, and notably real estate investing, where leverage is an important factor in financing capital investments. Cheaper credit usually leads to more investment in a particular activity, and again, I'll cite real estate and even more specifically, homes. Depreciation allowances that are allowed for business investments are another aspect of the tax laws that distorts the flow of credit. Allowing the immediate expensing of capital investments, for example, increases the amount of those investments, which in turn will increase the demand for credit to finance those investments. The point here is sometimes the law has a direct effect, and in other times it's an indirect or secondary effect. The federal income tax exemption for interest earned on state and local government bonds increases the flow of credit to the activities financed by those bonds because the resulting interest rate is lower. A recent one that's gotten a lot of attention is the tax treatment of foreign corporate earnings, which has the effect of holding capital out of the U.S. Economy, which in turn has credit allocation implications. And more specifically, when corporate debt is issued to finance a tax inversion, which of course is an increasingly controversial activity. Monetary policy has another significant impact on the flow of credit. It not only influences the price of credit, but also the relative price of credit across various maturities. That is short-term interest rates relative to long-term interest rates, or for the economists, what's known as the yield curve. That is, what is the difference between long rates and short rates? The excess flow of capital into housing in the middle of last decade, which led to the housing crisis, was driven in part by excessively low short-term interest rates, which made adjustable rate mortgages quite appealing to homeowners, which increased not only the demand for more homes, but also for larger homes. Again, a diversion of credit. The Federal Reserve's recent quantitative easing, or so-called QE program, which has ballooned the Fed's balance sheet to over $4 trillion, including $1.7 trillion of mortgage-backed securities, has effectively lowered long-term interest rates across all types of mortgages and debt securities. Those lower rates, again, will influence the flow of credit. Bank capital regulations also distort credit flows in two significant ways. First of all, varying the required capital backing for various types of bank loans and investments directly influences the interest rate a bank must charge on a particular loan or earn on a particular type of investment, which in turn will influence the amount of that type of credit that borrowers demand. The higher the capital requirement, the higher the interest rate, which in turn will reduce the amount of credit that a bank will provide for a particular type of loan or investment. Second, bank capital regulations influence the structure of financial intermediation overall. That is, the different types of financial institutions that we have in the economy, and specifically the amount of banking that takes place in the shadows of the economy, or what we call shadow banking, which in turn distorts the price and therefore the allocation of credit within the economy. Again, I want to reinforce that sometimes these are secondary or tertiary effects, but they're nonetheless real effects. The existence of shadow banking is an excellent example of indirect credit allocation effects and often the unintended consequence of bank capital regulations. Recent stress tests imposed on large banks will further distort bank lending and investing decisions. Government subsidy programs are another distorter of capital in an indirect way. And price farm supports are a very good example, because supporting a particular crop encourages overinvestment in certain types of agricultural production, and credit is widely used to support that overinvestment. Oftentimes that credit is supplied by the taxpayer subsidized farm credit system. Government insurance programs such as flood insurance not only distort the flow of credit, but often perversely influence where that credit is utilized, such as building of second homes in floodplains. Mispriced deposit insurance leads to the misallocation of credit by underpricing deposit insurance for banks that engage in unwise lending, while the Pension Benefit Guaranty Corporation essentially subsidizes undefined benefit pension plans, which themselves have substantial investments. State and local government credit distortions also are prevalent, such as tax subsidies and loan guarantees to businesses to invest in a particular state or locality. Such subsidies and guarantees directly influence the allocation of credit to a particular region of the country and activity. Nevada's proposed subsidy of the construction of a huge Tesla battery manufacturing plant in Nevada, whose construction will be largely financed by debt, is an especially egregious example of credit for cronies. Every one of these explicit credit allocation distortions has strong political support. Otherwise, they would not exist. However meritorious any one regulation, agency, program, tax break, or subsidy might be, oftentimes a payoff to political cronies, the multiplicity of these distortions in the credit allocation process, many working at cross purposes, has greatly encrusted the U.S. economy over the decades, dragging down long-term economic growth and exacerbating boom and bust cycles in the U.S. economy. And I look forward to our discussion and your questions.
Okay. Well, thank you, Bert. Although, and I do want to come back because I want to take issue with you on your pejorative use of the term shadow banking. But we'll get to that in a few minutes. But anyway, so let me turn the floor over to you, Paul, and
Okay, great.
you have a PowerPoint presentation, I believe, right?
I do, and I'll stand up too so I can see everybody. Thanks very much for inviting me. So I'm going to talk a little bit today about the government's hand in allocating credit and more through the banking sector. So the financial system has a real important function in the economy. It has to channel savings into productive investment activities. If we get good investments, we get strong economic growth. If we have poor investments, economic growth suffers. And in the U.S., the financial system is the banking system, the public securities markets, shadow banks, and they collect savings and allocate it to investments in all kinds of places, including foreign investment. Now, the Dodd-Frank Act has granted financial regulators an enormous amount of discretion for influencing the allocation and savings and investment in the U.S. financial system. And I'm going to come back and talk to that. But before I do that, I want to take a little bit of an issue with the title of this session. Is it the hidden hand, or the heavy and hidden hand? But is the hand really that hidden? I think if you go back and you look at the videotape of history, the government's been always been involved in money and credit allocations throughout history. And I'm going to rewind the videotape and give you a context for thinking about where we are today. So you might remember that guy's on one of your in your wallet, right? Andrew Jackson. So he was instrumental in killing the Second Bank of the United States back in the 1830s. He believed that the Bank of the United States it reflected money's interests in the East, that they were constraining credit to the Western territories, and they needed this money to buy land and things like that. And so he vetoed the re-charter and freed up, in essence, the state banks in the West to inflate land and to make more loans. Then there was the National Banking Act of 1863 and 1864 in the middle of the Civil War, and one of the prime motivations for that government intervention was to get people to buy the war bonds, the Treasury securities. They chartered national banks who had to buy these bonds as part of the deal to be a national bank, and they wanted to run out the state banks and taxed state banknotes, and there was a whole big fight, and Wayne knows all about that and can tell you about that afterwards. So then shortly after that, there was a pressure for a bimetallic standard. As many of you may remember, in 1873, the U.S. eliminated the coinage of silver. The world was moving to a gold standard, getting off a bimetallic standard. And what had happened after it eliminated free coinage of silver was the supply of money, which was driven by the gold stock, didn't rise as fast as the supplies of goods and services in the country, and we had this huge deflation starting in the 1860s. This deflation was especially hard on farmers and people in the West, people who had borrowed a lot of money. The Eastern folks were richer, that's where the banks were, that's who lent the money. Deflation is good for people who lend, it's bad for people who borrow, and this set up a dynamic. And what you may not realize before I go into that panic was the first quantitative easing programs actually happened in the 1870s. Ben Bernanke did not invent this. The Bland-Allison Act of 1878 required the Treasury to make monthly purchases of silver. Silver wasn't being coined anymore, so the Western farmers pressured the Treasury to buy some of their silver. And so they exchanged silver for gold in these QE operations, $2 million to $4 million a month. Okay, sounds like a QE operation. In 1890, that was replaced with the Silver Purchase Act, but shortly after that, in 1890, it stopped. And there was the Panic of 1893, which was the worst depression to date. Now, it started when a railroad, the Pennsylvania Reading Railroad, filed for bankruptcy. And back then, railroad bonds were the subprime debt. Everybody was trading railroad bonds. That was the junk subprime debt back then. And the collapse of the Reading Railroad led to collapse of hundreds of businesses that were dependent, and businesses that owned railroad bonds, businesses that depend on the railroad, and the stock market tanked, and 20% unemployment. And European investors started pulling their gold out of the U.S. market, and so Grover Cleveland at the time, I believe it was, pushed and repealed the Silver Act. But just think, if the Dodd-Frank Act were written in 1895, the railroads, not the banks, would be the SIFIs. They would be subject to enhanced prudential supervision, living wills, orderly resolution authority, and the railroad subprime bonds were the evil mortgage-backed MBSs at the time. It was railroads. So then we were set up for the push to inflate with silver, and I'm going to get back to modern times pretty quickly. But this is interesting because if you're channeling your inner Elizabeth Warren, in 1896 there was a famous guy, William Jennings Bryan, the handsome guy up there in the corner, and if you read one of the quotes from his speech, there are two governments. There are those who believe that if you just legislate to make the well-to-do prosperous, their prosperity will leak through on those below. The Democratic idea has been, if you legislate to make the masses prosperous, their prosperity will find its way up and through every class that rests upon it. And I just can't imagine that that's not going to get used again and recycled in another couple of years. So, I mean, history is full of these struggles. There was the Panic of 1907, which led to the founding of the Federal Reserve. And in the beginning, the Federal Reserve was about rules. There were two rules that guided the Federal Reserve: the gold standard and the real bills doctrine. The Federal Reserve only discounted real bills that self-liquidated in 90 days, essentially commercial paper. If you had good commercial paper that was self-liquidating in 90 days, you could rediscount it with the Fed and get liquid if you needed to. You didn't do any long-term bonds or anything else like that. But actually, that didn't last very long. 1914 came around, and the Fed sort of got co-opted by the Treasury, and it had to buy war bonds. And so it sort of started rediscounting war bonds, and the government, again, takes credit and allocates it towards its own uses to finance the war. In the late 20s, economists started having debates about, should you do the gold standard or should you manage a price index? And that's where Irving Fisher and Keynes and everybody comes in. But things got a lot more complicated. In the 1940s, again, the Fed was pushed on to finance World War II, and there it fixed the whole term structure. It fixed the short rate, the medium rate, and the long rate until it couldn't anymore, and there was a big inflation, and there was a big fight, and this resulted in the Fed-Treasury Accord in 1951. And in the 1970s, those of you that went to graduate school back around the time and I did, there was this whole thing in economics, and it's sort of gone to the macroeconomics today, was optimal control theory. And we were all sort of learning all this fancy math, and we sort of said, maybe we'll just take these ideas from electrical engineering. If we can think about the economy kind of like a big electrical circuit, and if we have enough dials here, if we can adjust the dials just ever so much, have so many instruments to affect the monetary policy, we can just smooth out the business cycle. And that was sort of the ideas in the 70s, and it sort of lingered. So it's the whole debate about how many monetary policy instruments you have, how many monetary policy targets you have. You have to line these up, and if you can figure out the relationships, the lead-lag relationships, you can tune the economy, you can tune all the bad stuff out of the economy. Unfortunately, it just didn't work, right? Investors react to that. They don't remain the same when the government changes its policy. There's something called rational expectations and the Lucas critique. So there were all these people back then that just thought if only the Fed had more instruments, then we could just smooth everything out. I think we're coming back to that right today. So the new crisis We had zero interest rates, special asset purchase programs, QE programs, huge expansion of the balance sheet. And now we're in the newest chapter of this rules versus discretion debate at the Federal Reserve. It's called macroprudential bank regulation. And so in its simplest form, these are regulatory capital requirements that can kind of move up and down in the cycle. So you get a 2% band, and somebody somewhere in the government turns this wheel, and all of a sudden bank capital requirements go up when there's a boom. And at some point, somebody somewhere decides, well, the boom's over, so let's turn the wheel the other way, and the capital requirements come down. And this is supposed to smooth out the cycle. Now, the Dodd-Frank allows for this in the rules, but it doesn't actually say who turns the wheel or who has the authority. If you read it real closely, and I can't find out who makes the decision to raise capital requirements or who lowers it. I would think the FSOC does, but it's not in the FSOC's duties. Presumably the Fed has something to say about it, but the law is unclear. So it'll be real interesting when they start using that one. But there's a lot of other newer incarnations of macroprudential tools. There's been targeted lending guidance on leveraged loans and auto lending. The Fed stress test is a very much a macroprudential tool that has a whole lot of discretion in it. I'm going to talk about that in a minute. And there's a whole list on the drawing board. There's Governor Tarullo's vision for proper bank governance, that big bank holding companies should implicitly take on the objectives of the Federal Reserve when they're running their firms. They should do what the regulator wants them to do. That should be part of their rules instead of serving shareholders. It's a strange idea for me. There's going to be TLAC rules. Not only going to be leverage ratios for bank holding companies, there's going to be minimum amounts of debt they have to issue, so that if they fail, we can wind them down easily. So there's a whole list of things here, and I'm going to get to it, some of these in a little bit. So macroprudential regulation in general. There's very few specific rules or limits in the law. It gives the central bank an enormous amount of policy discretion for regulating the institutions it oversees. And it has the power to expand its regulatory jurisdiction through the FSOC. So the regulators can decide, hey, those asset managers, they're a real risk to the economy. I think we need to regulate those guys. Okay, put them under the Federal Reserve. Congress doesn't have to act anymore. Huge discretion. So they have more instruments and powers, but a very vague goal, financial stability. So what is financial stability? That's the goal. Is it just that we don't have another financial crisis? Is that all it is? Is that the goal? Or is it something more than that? The law doesn't say. So we have all these powers, very little limits, with this vague goal of maintaining financial stability, which is pretty wide open what that means. So it's an open-ended remit with very few checks and balances built in. So some examples. The regulators, using these new powers, have really tried to short-circuit the leveraged loan market. They issued new regulatory guidance in 2013. They put out very specific debt coverage limits, or banks weren't supposed to underwrite these loans. And they included all kinds of language in these new rules that said, well, if you make risky loans, even if they're not a risk to the bank, if they're a risk to somebody in the economy, then we can stop you from doing it. If they're poorly underwritten, if they could create systemic risk somewhere else, then it's not a good idea and you shouldn't do it. And bank regulators have been using these new rules really to try to keep leveraged loans from being made and ended up in mutual funds, because they think high-yield mutual funds are maybe a place where they could run and that could be the next problem. And so they're really trying to stop that in the banking system using the rules. That's my opinion anyway. And if that's not enough, then they put it in the new stress test. In 2015, if you read the fine print, they said, well, when you do your stress test in 2015, what we really want you to do is really stress all those leveraged loans, because because we think you should satisfy more than the letter of the law. We think you should try to take into account our objectives when you're managing this. So we're going to come back and take a hard look at that in the stress test. Now, what is the stress test? And for those of you that don't know what a stress test is, well, let me get a help from Dilbert to explain. So what the stress test is it's a series of scenarios, a baseline scenario and some stress scenarios, and the bank is supposed to use economic models to model how it's going to behave in the scenarios, to estimate the losses that it might generate over a 3-year period. And here's an example of the first scenario. So I don't know this Dilbert guy's name. He's the little guy in Dilbert. But anyway, he says the first adverse scenario is it's a slow slide into oblivion. And the second one is the death spiral. And if that's not bad enough, then the rest of the global economy collapses. And before you're done, why don't you do the extremely adverse scenario? So the stress test provides the Fed with huge discretion to control large bank holding company operations. Okay, almost all the large bank holding companies, anybody bigger than $50 billion in consolidated assets has to do it. And banks bigger than 10 billion have to do it, the banks themselves. So the stress tests but they're more of an exercise in art and judgment than they are in science. They're made to look like science. They use econometric models. But they're really not. The econometric models aren't very good. I've done stress testing for years for the FDIC and for the IMF and other people. The scenarios are set by the Fed ahead of time. So you get some scenarios. And sort of, how do we know these scenarios are even relevant for the next crisis? And I'm going to talk about in a minute. But by generating some scenario that you have to run the bank's models through, you could pick something that makes the bank look really bad, even if that's not even a remotely a risk. So you get a lot of discretion that way. So models have only the weakest link between the profit and the loss the banks actually end up making and the stress. You can't link macro conditions to banks' P&L very tightly at all, and the fit of these models is actually worse in crisis conditions, and that's just the life. You just can't model them that closely. So let me give you an example of the Fed's recent stress scenario. So they go and they say, in the recent stress scenario, this is the adverse one, we want you to do all these things, the economy, the world falls apart, and make sure Brent crude oil prices, Brent crude oil, not West Texas, but Brent, goes to $110 a barrel. And these were put out in late October. So this is a stress scenario. So if you actually look at the price chart there, you'd say, well, why are we worried about that? Brent oil's been 110 plenty of times in the last 2 years. And not only that, isn't the biggest risk that prices are falling? So now banks, all the big banks have to spend millions of dollars simulating, modeling this kind of scenario when it's the wrong scenario. The Fed put it out in October. It's obsolete. So, and Ed could tell you how well fixed stress tests work to set capital at the GSEs, and not very well. That was the rule. Anyway, so what are the financial analysts worried about? Well, they're worried about oil prices falling and staying low because the growth in the economy has been in things like fracking and oil production. So the real risk is the firms that borrow to produce all this new oil, the oil price stays low, they can't pay back their loans. So it's a bit of a disconnect here, and it shows you the risks of doing the wrong stress scenario. And we're basing bank regulation, and banks are spending millions of dollars, probably that's a way understatement, hundreds of millions of dollars to do these exercises across them. So what's the risk? Will my bank pass these tests? They're known as, the acronyms are DFAST, CCAR. Will my holding company pass? It's almost entirely a Fed judgment call. It's total discretion. What happens if you don't pass? Well, the bank can't exercise its capital plans. It can't pay dividends. It can't buy back shares. It might have to raise additional capital. How does the bank defend itself against this? Well, you really can't, right? None of these models fit the data very well. What is the right model to fit the data? We don't really know. What is the Fed's model? The Fed generates its own losses. Well, they won't tell you that. There's really no answer. There's no defense. So, and the Fed can fail you on qualitative procedures and governance. Maybe the right people didn't look at the results or something, and it's really quite a judgment call. Other examples where discretion is very important and can influence the lending decisions are the FSOC-SIFI designation. There's no scientific basis for these really much in around DC area. We call it the Noah's Ark theory of SIFI selection. You want 2 of every kind. You bring them on the boat. Designation, so this is a way that the regulators can endogenously expand their jurisdiction. So there's other ones up there, choke point, disparate impact to exercise fair lending laws. But I want to leave you in the last couple of minutes with the fable of Dr. No and his fabulously scientific investment strategy. Now, Dr. No is a widely recognized and widely recognized as a brilliant economist. He uses advanced approach to manage investment portfolios using all asset classes, derivatives, trading methodologies, anything his team wants to do. And just to remind you, there's a picture of Dr. No, 1962, and he's got this fabulous investment strategy. Now, let's say the central bank hires Dr. No to manage macroprudential regulation. In other words, he's going to use the financial tools and regulations to control the economy's investment flow. So we don't have too much systemic risk. We're going to have financial stability. We're going to stop risky investments, and we're just going to smooth everything out. Well, did everybody live happily ever after? Dr. No managed to create a macro investment strategy that literally could not make money, ever. It's really a hard thing to do. It's not a good outcome, but it's difficult. His strategy lost money in every quarter. It had a negative 7% compound return. So It lost money in 2011 in a bad market. It lost money in a good market in 2012. It lost money in a raging bull market in 2013. And it earned 8% when the S&P earned 15%. And the little blue line is how Dr. No's investment strategy worked and compared to treasuries and S&P. All right, so what's the moral of the story? Well, Dr. No is actually a real economist, and he really is the best of the best of the best. And he runs a hedge fund, and his hedge fund did really badly, and those are the real results. But Dr. No is exactly the kind of star economist that the Federal Reserve will hire to do its macroprudential policy. The tool was to have a good return, a liquid return, and the dangers are you put all your eggs in one basket. So the moral of the story is, who do you want to trust with your future? Millions of individual investors, Paul, myself, making our own mistakes, taking our own risks, or is a couple of smart people in the central bank? And they really are smart. But those are the kinds of things that can happen when you have central planning controlling investments. And I just want to leave you with that.
Great. Well, thank you very much, Paul. Good broad sweep there. So now let me turn it over to Ed DeMarco, who, Ed, let's look at some of your experience in the specific area of housing.
Thank you. Good afternoon, everybody. It's an honor to be here. I'm going to take a little bit different approach. I am going to focus just on housing, perhaps as a case study. But to Bert's earlier point, I'm just going to touch on a few things in housing, because if I was to stand up here and talk about all the different ways in which the government affects capital flows in residential real estate, we would be here till dinner. But I want to come at this issue a little differently. So as an economist, I think about government intervention in credit markets first as a response to a perceived market failure, right? So what's a market failure? It's simply the failure of a market mechanism to allocate resources efficiently. And this can be because that there's some kind of externality. So in a typical example in manufacturing, that pollution can be viewed as a negative externality to be considered in terms of whether the market's actually efficiently allocating resources. There can be positive externalities, and certainly in housing, having citizens that are homeowners is often viewed, I think in a nonpartisan way, as having positive externalities in terms of stability and strength of local communities, as well as the opportunity that may provide households to build their own financial wealth. But as I see it, what I'm going to note is that part of the problem in housing is that even when the market failure that caused the original intervention ceases to exist, the programs and subsidies that are put in place are almost impossible to turn off. Instead, the beneficiaries of these subsidies, in this highly technical term in the title to this panel, the Cronies, emerge as vested interests in preserving these subsidies going forward. So let me take a somewhat loose story of the government's role in housing, because I think there are parts of this story about the government involvement that are actually positive, that I think demonstrably led to more efficient markets and improved social welfare. If anything, as I say, the government's problem is it doesn't know when to declare victory and go back home. And this is in part where some of these cronies or these interested parties come in to preserve these market distortions, these market corrections that the government's tried to introduce. So let's just think about housing. If we go back pre-Depression, or the time of the Depression, the country had a relatively low home ownership rate of about 40%. To get a home loan, to get credit to purchase a house, typically involved something like 50% down, and it involved balloon payments that were due in 3 or 5 or 10 years. And funding of this was done by savings and loans and savings banks. Now, in the Depression, of course, we had quite an economic collapse. House prices collapsed. There was a tremendous number of foreclosures. So the government took a series of steps in the housing market, and part of this is to deal with market imperfections, and some of it was to promote social benefit. So in terms of market impediments, the government saw, or thought that it saw, that if one could move to an amortizing mortgage over a somewhat longer period of time, that this was a more stable instrument for financing residential home ownership. But there are a couple challenges to that. One, it didn't exist in the marketplace, and you had lending institutions that were borrowing short with deposits and needed to make these longer-term loans. We also had a banking system that was largely unit banking. We didn't have nationwide branching, and we didn't have the financial technology we had today. So we had some parts of the country, think about maybe New York or Boston, in which there may be a surplus of capital, of savings, but we didn't have efficient technology to necessarily move that to the other parts of the country that were growing. So this is sort of the positive story of, rationalizing government involvement. And then, of course, the social benefit of home ownership. Home ownership was seen back then, as it is today, as a route to economic opportunity and security for citizens. So these market impediments, these financial technology limits, the social benefits created this positive argument for government intervention to enhance housing markets. And in fact, there was a series of interventions that were taken, a series of programs and agencies put in place. So you had the establishment of the FHA, which introduced and brought into place the amortizing mortgage. You had the creation of Fannie Mae in 1938. Fannie Mae designed to create liquidity to these FHA mortgages, to not just buy them, but to buy and sell them, to be able to facilitate that movement of capital. And you had the establishment of the Federal Home Loan Bank system, again, as a mechanism for moving capital from one part of the country to another. And I think that one could view this as having, had, some success. In fact, in less than 20 years, the home ownership rate in the United States jumped from 40% to the low 60s. So it was a substantial movement of the needle with regard to this allocation of capital in residential real estate that had, a truly seismic effect on home ownership in the country. But then think about these things and sort of where they have gone from here. So to take FHA, FHA successfully demonstrated the viability of an amortizing mortgage, and it did have this positive effect on home ownership rates. Interesting thing about FHA back in the day is that the underwriting standards were really quite strict, even though they were introducing this new instrument, and default rates on FHA loans were really quite low. But if we sort of fast forward and we look at how FHA is conceived today, and we look at the change in what is considered acceptable underwriting in FHA today, we have a much different story. I think the folks that were running FHA those first several decades would look at both the underwriting standards and the default rates that we have in the FHA program and be horrified. They wouldn't believe it because it was so outside of, their mindset about, what they were trying to accomplish in terms of trying to make that flow of capital and housing more efficient. But we didn't get everything right. In fact, even in the FHA program, there was rather explicit, discrimination taking place in the way these programs run. So this became another barrier to overcome, not just in housing, but in larger consideration of credit access. And that is removing discriminatory practices in terms of the allocation of credit. So you have government interventions, and they're not just sort of well-intentioned, but in times, quite justifiable. But, where do we end up with these things when we don't know sort of how to turn them off, or when they start to take on additional missions or activities, or are manipulated in part by people that have a real interest in keeping this going? So let me turn to Fannie Mae and Freddie Mac. Fannie Mae was originally created, as I said, to buy and sell loans to create a secondary market to bring liquidity to the FHA market. It later got involved. Freddie Mac was created in 1970, and they continued to operate essentially a secondary market. Fannie tended to buy and hold mortgages, and Congress had to correct that in the 1950s, but this was their function. They did not invent the mortgage-backed security. That was actually done by a different government agency. It was done by Ginnie Mae, and then Freddie Mac and Fannie Mae followed. We get to the mid-90s, and in the mid-90s, in 1996, the Treasury Department, under a mandate from Congress, had to write a report to Congress saying, you know, is this still necessary? Do we still need government sponsorship of Fannie Mae and Freddie Mac, or should we truly privatize them? That is, sever all the government support, subsidies, implied guarantees, and so forth that surrounded Fannie and Freddie. And the Treasury Department, in a report that, you know, I will, in full disclosure, had involvement with, the report signed by Larry Summers, the Deputy Secretary, went up to Congress, and the thrust of the conclusion was, well, with regard to the functioning of the securitization market and having a secondary mortgage market, in fact, we probably don't need government sponsorship. This market has matured, it's been demonstrated, and it could operate just fine without all these government supports. But 3-4 years earlier, Congress of the United States had given Fannie Mae and Freddie Mac these housing goals to support affordable housing. And the report said, you know, this has just started. We haven't had an opportunity to really recognize whether having Fannie Mae and Freddie Mac operating with these affordable housing goals can make a meaningful effect on home ownership rates and expand affordable housing. So let's not privatize them. We're not going to recommend privatizing them. We think that this new mission, this expanded set of activities, is what we ought to pursue. You know, we have lived the consequences of that over the last 8 to 10 years. But let me note one other thing, and this maybe gets to, there are some parts of government intervention that really are still a bit of a hidden hand. And that is, how did Fannie Mae and Freddie Mac take their subsidies and actually, you know, implement them in the marketplace? Well, some of these subsidies were captured by the shareholders and managers. But, you know, part of it, and I think this is what, you know, some policymakers find very attractive about this GSE structure, is that they are in fact hidden tax and transfer systems. And the way this works in the GSE construct with Fannie and Freddie is that the way the pricing mechanism for this financial guarantee worked is that they were essentially overcharging for high-quality borrowers. So if you got a 15-year mortgage, you were definitely paying more than you needed to relative to someone that got a 30-year mortgage. But they were also taking the high credit quality borrowers, overcharging them, and undercharging the higher risk borrowers. So you had people that were demonstrably managing credit well and posing a low credit risk in their mortgage, paying more for a credit guarantee in order that another segment of borrowers that were much higher risk paid less than what the marginal cost of that risk was. And so this cross-subsidy within this program is effectively a hidden tax and transfer mechanism. So one could ask whether Congress would really enact a bill that says we want to charge 10 or 20 basis points or whatever your number might be on highly qualified borrowers in order to subsidize the access to credit for less qualified borrowers. And the other thing about this, of course, is that this actually creates more risk for these weaker borrowers, and I'm going to get to that point, turn to that point now. So today, we've just come through the worst crisis in housing since the Great Depression. Our home ownership rate, after briefly flirting with 70% at the height of the housing bubble, is now back around 64%, which is roughly where it has been for the last 50 years. Yet, it is as a result of the government responses to the Great Recession, taxpayers back roughly 80% of the mortgages being made in the United States today, either through FHA or VA and Ginnie Mae, or through the taxpayer backing of Fannie Mae and Freddie Mac. Now, while there appears to be bipartisan agreement this is way too much government involvement, there is no consensus on how to dial this back. Moreover, The housing industrial complex of housing advocates and the various industries involved in real estate are on high alert to block actions that would diminish government subsidies to housing. Since representatives of this complex reside in every congressional district in the country and they are politically active, we have a vast and widespread group of interested parties to oppose any meaningful withdrawal of government support from this credit market. So I'd like to end with two observations. First, one of the brutal ironies in all of this is that the families intended to be the biggest beneficiaries of this federal intervention in housing are the ones most greatly damaged by it, namely first-time home buyers and low and moderate income families. My second observation is that the private capital markets have not exactly wrapped themselves in glory. From past history of overt and hidden discrimination to more recent abusive practices in steering customers into inappropriate mortgage products or willingly making loans they knew borrowers would have a very difficult time repaying. The private sector also has some things to answer for. So while government's heavy hand clearly directed more capital and continues to direct more capital to housing finance than would otherwise be the case, on the other hand, we're left with the challenges of ensuring we have appropriate laws and regulations governing the working of our credit systems, and among other things, supervising for practices such as predatory lending and being mindful and attentive to the buildup of systemic risk, whatever one might sort of envision that to be, because we have seen financial calamities really do have harmful effects on the real economy and on real families, and the damage and pain, of this last go-round is something that ought to keep us all alert to how we structure market systems that allow for the efficient allocation of capital by private markets, but also respecting an appropriate role for government oversight to ensure how these markets actually operate. Thanks.
Great. Well, thank you very much, Ed. Now, I wanted to, after this great kind of overview here and focusing on housing as well, I wanted to turn back to Bert real quick, because Bert, you were one of the early predictors of the S&L crisis back in the 80s and the ultimate taxpayer bailout of FSLIC for the thrifts, and you helped people on Dodd-Frank and whatnot. So I wanted to ask you what your view is, given Ed's overview of the housing market and all the forces that are behind, driving government policy, what your view of the current situation is.
Well, first of all, I think Ed has characterized it very well, particularly in terms of the difficulty of bringing about change, particularly changes that acknowledge prior policy errors. We have housing is probably one of the most government-distorted sectors of the economy, and it's widely recognized as such. But the difficulty of bringing about change is enormous, in part because, as imperfect as the system is, there are literally hundreds of thousands, if not several million people employed in what Ed calls the housing industrial complex, which I think is a great term, who are very comfortable with the status quo. Another way to put it is, particularly today in housing finance, things aren't working that badly. Mortgage credit is available to most people, and so in that kind of situation, there's a tremendous reluctance to bring about meaningful reform, which is why we get this paralysis that unfortunately will continue until until the next crisis erupts. So we have this paralytic situation that is unfortunately very difficult to break through, particularly in a non-crisis time. And if I can go back to the S&L crisis, that crisis was building all through the 80s. I and others were starting to talk about eventual taxpayer bailout in the mid-80s, but nothing happened until 1989. Why did it happen in 1989? We had a new president, which then President Bush 41 came along, and his administration brought about change. But things had gotten to the point that there was going to be a taxpayer bailout, so it took a crisis, to a financial crisis, basically, to bring about change. And unfortunately, we haven't taken full advantage of this most recent crisis to bring about the changes that are needed.
Yeah, there's also tax implications too that triggered it as well back there. But Paul, do you have any?
I would agree. I think you just need to realize that certain interest groups think they have claims on certain transfers now, and somehow you have to cut a deal where, you know, there's give and take, and I don't know how that works out, but people don't give up subsidies easily.
No, they don't. Well, but one thing I really, to take the other side, remember, you know, you didn't build that, right? We have to remember that banks and others, you know, are feeding at the trough of the taxpayer through deposit insurance and other sort of gimmies. And so shouldn't the people of the United States be able to get some of that inherent subsidies that's flowing to the haves, and shouldn't it be spread out to the have-nots? So like when Ed described how you know, you know, this has broadened the ability of people far and wide to get mortgages that otherwise they wouldn't, and CRA has helped on that, I would say, as far as broadening the ability of people who were green-lined out of the situation. You know, shouldn't it be the role of the government to take up this market failure and bring about change?
Which one of the three of us want to jump on Paul for that?
Ed?
Well, so look, I mean, we live in a democracy, and we make decisions with regard to these things through elected officials. So I think part of what I would submit to that is, you know, how is this being done? If it is being, if there's interventions that are done transparently by elected officials, where the funding of activity is transparent, the use of it, the reporting of it, the accounting of it is transparent, and that then it is subject to the determination of voters to say, you know, that we like this direction, we don't like this direction. That's a different thing than when things are hidden through off-balance sheet mechanisms, through the manipulation, whether through statute or regulatory processes, of private actors to essentially sort of do the bidding of the government in a way in which it lacks this sort of transparency. To me, that's a more insidious approach to things. So while I've got a great deal of concern with certain aspects of FHA, the one thing you can say about the FHA program is that it appears on the government's budget, and so the accounting for it, as weak as it is being government accounting, at least has a level of transparency and accountability that is really absent when you look at things being done through something like a GSE model.
But so I guess, so hey, we kind of screwed up then over the last few decades, and we allowed Fannie Mae and Freddie Mac to kind of grow, and through you know, spreading of political contributions and whatnot, they built up this great engine of lobbying. And as Ed, as you said, the realtors, the contractors, the bankers, the insurers, they're out there, and you know, they see you know, where their bread is buttered. So are you saying then that maybe what would solve this whole problem going forward is to, if we have Dodd-Frank Part 2, maybe we should just have specific subsidies going to Fannie Mae, Freddie Mac, and then thus to the mortgage market? Or how would you all, what do you think is the ultimate way to unwind?
If I could just jump in on this. You know, the simple fact is, politically, the way things work in this town, you never get nice, simple, clean solutions. And particularly when you talk about trying to redistribute the subsidies, those who have them don't want to give them up. And that becomes, again, part of the paralysis that we exist. that we have is that every subsidy that's out there, every program that's out there has powerful support for it. Otherwise, it wouldn't last. And so the challenge is, how do you break away from what we have today? And what the consequence politically usually is that more gets layered onto it. And so over time, these programs, and particularly in the area of housing, get increasingly complex because of the multiple layers that get put on over time.
Yeah, I think that's quite right. Just to build on Bert's point, I mean, so the agency, the Fannie Freddie mortgage-backed security market, is a $5 trillion market. And there's a lot of pieces of that market that different market players have hived off and built their business model around so that they can get their portion of it. It doesn't make this the most efficient way to be doing things now, but in fact, it's part of this. So just think about the dealer community dealing in the buying and selling of mortgage-backed securities, saying nothing of, of the front-end mortgage market participants. And these are the vested interests that have taken their private capital, their investments, their business model, built it around sort of this government created infrastructure. And so to change that infrastructure affects the business model of all these other firms that have built P&Ls and a pretty good life around the way this works. And that is very, very difficult to unwind. And then you get arguments, oh, well, you can't do that because that's going to affect affordable housing, or it's going to affect this. It may not have anything actually to do with affordable housing or consumers. It really has to do with the vested business interests of those that have found their place along this food chain.
If I could, I know that that's shocking to a lot of people who don't live inside the Washington Beltway, but we do have all of these special interests that are constantly looking out for number one. And that's a very human aspect of the political process. And we have to accept that that's going to exist. And so the question is, I think, as maybe Paul said, how do you come up with a deal that enough people will buy into that you can bring about meaningful change? And oftentimes it takes a crisis to do that.
I think, just to add a little more, I think Dodd-Frank has made it worse because it didn't address any of the fundamental problems with the GSEs, and then it layered on things like the QM rule, which totally relies on the GSEs to make mortgages that are otherwise banks wouldn't make, with all the lawsuits and everything else built into this, destroying the credit culture. I mean, this whole idea that, not only do you didn't take out that loan, you don't have to pay it back if, if something goes wrong in 3 years, it's the banker's fault. I mean, the GSEs are critical to making the current version of the QM rule actually work and mortgage markets go through, and that compounds the problem, because you do away with them, who makes mortgages under the current environment? I mean, there's a lot of things that have to get dealt with here, I think.
But going back to the original point, oh, sorry.
May I add to that? Since some of you may not, may quite fortunately not spend your lives, worrying about this sort of part of our economy or financial markets or housing finance, but the qualified mortgage rule. So this is a rule. It predates Dodd-Frank, but it was substantially changed and modified in the Dodd-Frank rule legislation. So this is essentially a rule in which a lender has to make a determination about a borrower's ability to repay a loan. Now, how many of you, would have just sort of naturally thought that a banker needs to have a federal regulation to say if you lend the bank's money to someone, you've got to comply with a federal regulation to make sure that that borrower can repay the loan? And yet that's what we have. And we have it in part because of abusive practices in the lending community, but it really does sort of stand out as, if you really step back and said, really? We need that? But then the qualified residential mortgage rule, so not to get all our Qs confused, but the qualified so QM was meant to be a protection for the borrower. Qualified residential mortgage rule is supposed to be a protection for the investor. I mean, Barney Frank thought this was one of the cornerstones of the Dodd-Frank legislation, was that lenders originated these bad loans and then sold them off and had no further responsibility for it. So the qualified residential mortgage rule was supposed to define, supposed to basically say in the asset-backed security market, including mortgage-backed securities, that if you're originating mortgages and you're selling them off in the secondary market, you need to retain some skin in the game, some credit exposure to that so you don't sell off a bunch of junk. And yet we had a regulatory outcome after 4 years of rulemaking that has written a qualified residential mortgage rule that the exception is so broad, one could say it eviscerates the statute, in that it is treating, most mortgages as being qualified residential mortgages, and hence, there's not going to be a whole lot subject to this risk retention. Whereas when Congress enacted this law, they thought that they had passed something in which a substantial portion of the mortgage market that went through the secondary market would be subject to risk retention as a prudential standard to make sure the lending institution had ongoing responsibility for that loan.
Now, if you all have questions, I don't want to, ignore you as well. So if anyone has questions, please, raise your hand, and otherwise,
We got the mic in the back.
We do. Oh, okay. Thanks.
Thank you very much. During the 2008 period, J.P. Morgan was accommodated the government by taking over Bear Stearns. With TARP, Jamie Dimon objected, said he didn't need the money, but was forced to take it. Citigroup's stress test numbers were fudged so that they could pass. The AIG bailout really was a Goldman Sachs bailout. Next scenario. All three of the credit rating agencies looked at tranches and rated some of them AAA. But one of them, Standard & Poor's, said that the government debt a couple years later should be downgraded. So my question, and as the first part, you see Jamie Dimon's J.P. Morgan every few weeks paying another $1 billion into the government for some transgression. You see Standard & Poor's being the only agency of the three that's being chased by the Department of Justice. So the question really is selective enforcement adversely affecting flows of capital?
There you go. That's a topic for a whole nother panel, but I think it's germane here, so do you all have...
I think fines are good political news for, and that's what's going on, right? And what banks do you rob? The ones that have the money. So, that's the way I see it. It's not that, I'm sure bankers have done stuff wrong, and if they do stuff wrong, there should be consequences, but a lot of this looks political to me, but I'm not inside the investigations.
I would agree with that. I think there are a lot of politics in this. I'm not sure how selective it is. It seems like they're going after everybody they possibly can, and I think in doing so are trying to cow a lot of banks into going along with these industry-wide or at least very broad settlements that, from conversations I've had, their real preference would be to fight it. They feel it's unfair, but because they're highly regulated institutions, there's also a tremendous reluctance to fight back too hard. And I think that's one of the dangers in a highly regulated industry, is the extent to which the regulators can put the thumb down and say, they don't even have to say it. It's just kind of understood that if you push back too hard, fight too hard, you're going to pay the price. And the TARP, the fact that the large banks had to accept these investments from the government, even if they didn't need the money, is a very good example of that. And we'll have a speaker here later today who's John Allison, the former CEO of BB&T, one of the banks that had to take money. And John is very outspoken in saying, we didn't need the money, but we had no choice but to take it. And I think it ties in with this idea of the enforcement that the banks and other financial firms are really almost being forced into these deals. So I think the question is not even so much selective enforcement as it is, in many cases, overly broad enforcement and an inability, as a practical matter, for these companies to fight back.
Yeah, and just to add to that, so from my own experience at the SEC and how, I saw the SEC deal with Spitzer back in the 2003 to 2005 time period. There's the huge pressure, and then putting back on my lefty hat here, seeing that we don't have a lefty on the thing. There's been this huge pressure for headlines, and no banker has gone to jail. You hear that over and over again. And so there's a huge pressure on this administration, especially to bring cases, to show that they're active, and to really gouge the people who supposedly came out on the better end of things, as the view goes, after the 2008 financial crisis. Because one argument is J.P. Morgan got Bear Stearns for a song, and other sorts of things, and other banks did as well. Of course, people ignore the knock-on effects of litigation and everything else coming out of that, and just the bad business deals that then came to light. So there's that huge pressure that then allows the prosecutors basically to win these big settlements, because it's very difficult for a financial services company to fight its regulator. And with respect to, you have all sorts of, you're trying to manage money for people, you have boards who are looking at you, do we go with you or not for our public offering, and this guy's being attacked by the Department of Justice saying he's criminal or whatever. Over and over again, it's that comes home. And I had a head of a rather large investment bank in New York tell me that one day in the well of the Senate, there are politicians who excoriate his firm, and even people personally, and then the next day will be up in New York asking for money. So my question was, well, did you give him any? And so there was no response. And so then I shrugged and said, what do you expect? The dog bites you, and then you turn around and give him a bone, he'll bite you again. And so unfortunately, that comes into play as well. So it's a complicated issue, and but the people in power know how to exploit it, and for their own benefit, really, is what it comes down to. Thanks.
Hi, Albert, Port Angeles, Washington. A couple of years ago, I believe there was a constitutional challenge to some aspects of Dodd-Frank winding its way up through the court system. Dodd-Frank, I think, has some provisions in it that are even more blatantly unconstitutional than Obamacare, yet it sort of has flown under the radar screen with all the flack being concentrated on the Affordable Care Act. I'd like to ask the panelists, do you believe that there are any provisions of Dodd-Frank that should be overturned or repealed, and what do you see the practical likelihood of that happening in the next 3 years?
Replace and repeal, or repeal and replace is my view, but I don't want to steal your thunder here.
Yeah, I had a piece in the Wall Street Journal a week or so back where I don't think repealing Dodd-Frank in the next 2 years with the president in office is a possibility, really. But I think there are some changes that would be very beneficial that could be agreed upon and put through. And I think one of them is this raising the SIFI limit from 50 billion, which is a really relatively small, unimportant bank. I mean, if you're a $50 billion banker, I don't mean it badly that way, but you're not systemically important. If a $50 billion bank holding company goes bankrupt, it's not going to be the end of the world. If it is, what are all those regulators doing that are supposed to be keeping our system safe? So a $50 billion bank is way overregulated. It ought to be much higher. 250 billion is an easy one. 250 billion gets a lot of the regionals out of all this excess discretionary regulation. So that's one thing I think that both sides of the aisle have a chance at agreeing on. I think another one is the FSOC designation for non-bank SIFIs. I think that has constitutional issues. I mean, the due process involved is very fuzzy. The regulators don't really have good arguments, and yet and the companies don't really have a way to fight it, because once you're designated, do you really want to take your new regulator to court and then live with them for the next 10 years and have to go do the stress test and all those kind of things he can come up with? It's a pretty tough situation to be in. And I think the third one, I think the living wills is one that makes no sense, and both people on both sides of the aisle have sort of talked about that. I think that could be changed to be a more sensible rule focused on if a bank fails in an FDIC resolution, and it's a big bank, the FDIC can't sell it whole to another big bank and create a too big to fail institution, which is essentially how we got the big institutions right now. So I would stop that practice, and Dodd-Frank actually says nothing about that, although the Fed did pass a final rule last week that said holding companies can't have certain concentration levels, and that might affect that, but that'd be another reason to revisit living wills and focus it not on the bankruptcy of a holding company, but on the failure of a depository institution. But those were my 3 easy wins, and there's a million others that ought to be revisited. I know people would like to get rid of the CFPB. Again, I don't think that would get signed. Reeling it in some ways would be great, but I don't know how far you get on that. I think there's, in the next 2 years, there's hope for some improvements, but I think getting rid of everything is probably not on the table. So why don't
I said
turn it
3
over?
years advisedly to take it beyond the next presidential election.
Yeah, okay.
Just with regard to the constitutional challenge, here in the practice group a couple of years ago, we had a lot of discussion about that. Some attorneys did take a close look at mounting a challenge. I believe that there have been some initial court actions that turned out not to be successful. And my sense...
Well, actually, okay. Well, go ahead, but I'll deal with that.
I'm going to let you speak to it.
Yeah, so there is a challenge, and actually there's a hearing next week at the Circuit Court of Appeals here in the District of Columbia, but it's called the State National Bank of Big Spring, Texas. And so finally, you know, it was tough to do, but folks found Jim Purcell, who's the CEO of Big Spring, the State National Bank of Big Spring, Texas, which is a smallish bank. But anyway, he mounted a challenge. He had the temerity to stand up to his regulators, and he's a tough guy. And I think you know, they've brought a good case, and it's challenging basically Titles 1, 2, and 10, which is, you know, the FSOC is Title 1. Title 2 is the so-called Resolution Authority, which gives incredibly broad powers to the FDIC, and then Title 10 is the CFPB. But basically, you know, one of my favorite ones about it is going after the sci-fi designation process that Paul was talking about that the FSOC has, because it has separation of powers implications, appointment clause, and then just Article 3, powers of the judiciary. But basically what it purports to do, it gives these broad powers to the FSOC to, in a star chamber-like thing, go ahead and designate you know, an activity or an institution as systemically important. But then there really is no recourse. So what's really interesting about both the Prue case, about the MetLife case, which is right now, is that Roy Woodall, who's the presidentially appointed and Senate confirmed insurance representative on the FSOC, on the first round, which is done in camera, you know, there is no right for the potential designated institution to be in the room while the FSOC is considering what the staff is presenting to it. But Roy Woodall, basically, in an Obama-like thing, basically voted present. He did not vote aye or nay, whereas his other colleagues did. So what that does then is set up the right of appeal by the institution, MetLife in this case, to go before the FSOC, which will happen here in the next month or so, for them to say, oh yes, the staff may have told you that we're systemically important, but this is what we really think and why we're not. Then, you know, as will probably be the case, the FSOC will say, okay, yeah, we hear you, but too bad, you know, we agree with the staff. Then MetLife would have the opportunity to go before the circuit court or district court, I'm sorry, to appeal it. But the judge is restricted under the statute to only look at whether the action of the FSOC is arbitrary and capricious, which we all know is a very low bar for the agency to hurdle. It's basically if they were drunk and you know, didn't pay attention to other information, which could be the case. I mean, you never know. But anyway, but I think you know, I should hope that a federal judge would not look very favorably on a provision like that. But that's only one. That's basically Section 113 of Dodd-Frank. And of course, there are 2,319 pages of other just incredible things buried in there. And unfortunately, you know, Obamacare is like a Jenga puzzle. If your kids ever had that, it's a stack of blocks. And the goal during the party is to pull out the blocks and see who will pull out one that causes the whole thing to collapse. Obamacare is, you know, kind of, there are provisions that if you take out enough of the blocks, it will collapse. Unfortunately, Dodd-Frank, which was a huge giveaway to all sorts of special interests, trial lawyers, unions, and whatnot, is an amalgamation of things that, you know, can stand alone, frankly, and you have to pick them apart. And so there's some folks on the Hill who think, why should we start to, you know, get rid of things here and there at Dodd-Frank? Shouldn't we let just people stew in the juice, and then that will build up more pressure to repeal the whole thing? I'm not sure that that's the case. You know, maybe we should take an incremental view of it and get rid of low-hanging fruit where we do have a good bipartisan you know, support, and there are lots of them. Title VII dealing with derivatives, some of the things that Paul pointed out. So it's you know, it'll be interesting to see how the strategy takes shape. But to your point, I think as the economy falters with banks being burdened by all the regulation, I do take exception to the whole issue of the pejorative term shadow banking, because thank goodness we have the capital markets that are able to disintermediate the banking industry, with all due respect to Wayne and his colleagues at the ABA, because from money market mutual funds all the way to today, where if banks are not able to lend and are not able to meet a market need, then thank goodness that there's capital markets out there that allows you know, more competition and shows the folly of the regulatory state.
Well, you know, that's fine to a point, but the problem is where a lot of systemic risk lies is over in the shadow banking industry. But we also have to ask, why do we get to the point that the banking industry, the commercial banks, are so strangled by regulation that they have a problem in competing? The other thing we have to keep in mind, too, with the growth of shadow banking is technology has facilitated a lot of this. A lot of transactions done in the shadow banking world today would have been uneconomic or just not even conceivable 20, 30, 40 years ago. And so I would suggest the emergence of shadow banking, pardon me, is a strong indication that regular old mainline commercial banking is grossly overregulated.
Well, I agree with that, and thank goodness that we have the capital markets, which, you know, again, I take exception to the term shadow banking. I think they're, you know, regulated, it's in the open, and it's hardly in the shadows. The real shadow bank is the Federal Reserve and all of the, you know, the informal rulemaking that's done by these bank regulatory agencies that don't operate, you know, by the rule of law and with due process. But we have another question.
Well, Professor DeMarco, when you were talking about Fannie and Freddie, it was reminding me a lot of another program, the Federal Student Loan Program, specifically in the ways that you were talking about the cross-subsidy that the program creates. And I was wondering if you see the same sorts of crony credit redistribution and credit distortions in the Federal Student Loan Program.
So I do not want to hold myself out as an expert or even that knowledgeable of the student loan program, but I would, let me try to at least provide something useful in response. First, the student loan market used to have its own GSE, Sallie Mae, and interestingly enough, this was a case in which the government truly did end a GSE, completely sever its government sponsorship for it, and put it out into the private market just as another state-chartered corporation to operate. So Sallie Mae used to be a GSE like Fannie and Freddie with the same indicia of taxpayer support. No longer has it. I can't help but resist to make one comment about these things that's different. So forgive me, but I'm going to use this as a little launching point. You know, there's an interesting question here about government policy with regard to promoting credit and leverage as opposed to promoting savings and, you know, personal responsibility with regard to one's major expenditures in life and how one prepares for it. And we spend an awful lot of time subsidizing and incentivizing households with respect to taking on credit, whether it is to purchase a house or to go to college or whatever. And perhaps we should think a little harder as a matter of public policy in helping to incentivize and create a rich environment for households to be able to take responsibility for these major life expenditures by not taxing the first dollar of savings or interest. That you don't make any interest on a bank account these days, but I mean you get the basic point that we think about providing our help by helping households leverage as opposed to helping households save and build the resources internally to be able to manage major life expenditures and life events.
Yeah, amen with that. And it's tax policy, of course, but then also the really invidious zero interest rate policy that the Federal Reserve now is doing, which is decimating savers and pensioners, and I think is setting us up for huge problems, as far as, once the tide recedes and you see on the beach all the trash that's left there. But when people are ripped off by, too good to be true types of things that they're being sold because, they don't earn money off of their banking and savings accounts. But we're getting the signal that we need to wrap up, so I don't know if you all have any last words of wisdom. No, but anyway, well, thank you all for coming. There's, great session coming up, so go get your seats there. Thank you.